Hello, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. With this video, I will be presenting 10 additional dividend growth stocks that I consider fairly valued in today's overheated market. With my first research candidate, I'm going to look at Verizon Communications, currently offering a 5% yield. What I've got on the graph so far are the company's earnings per share going back to calendar year and fiscal year 2000. I want you to notice that there was an area here from the end of 1999 through 2012 where earnings growth was actually very weak, and that was followed by 2 or 3 years of very strong growth, again followed by some down years and then some forecast growth going forward. What's important though, part 2 is all about dividend income. So next I'm going to put dividends and reflect the dividend payout ratio. Now, two things are striking about what you see on the graph here. First of all, I want you to notice that the dividend growth has been reasonably opportunistic. We had no growth for the first 4 or 5 years here up through 2004, and then 2005 and 6 saw an increase in dividends, but it stayed the same for 06, and then we started to see a steady increase of dividend income growth going forward. Now, when I add monthly closing stock prices to this graph, you can see the effect that earnings have had on stock prices over the long run. Here we have a period in January of 2000, often referred to as the irrational exuberant period, where Verizon was trading at a very high PE. And I want you to notice that performance over this period of time was very poor. It actually ended up with a negative 3.2% annualized rate of return. But more to the point, you would have lost almost half your money investing in Verizon. However, from another aspect, if you went and looked at the dividend income stream, you can see that they kept that flat dividend for those years, as I alluded to earlier, but it produced a pretty decent dividend income stream. And most importantly, as it relates to the theme of these articles, Verizon actually produced more cumulative dividend income than the market. However, it ruefully underperformed even during this period when the market didn't perform very well. However, this series of articles is primarily about valuation, so I'm going to shorten the time frame here, where I start with a time where Verizon was trading at a PE of 13.4. And what I want you to notice, there's a significant difference in your performance based on valuation. At this point, we still see a similar pattern of dividend income. We got a little better dividend income growth, but keep in mind that growth relates very closely to the company's earnings growth over that time frame. But once again, we see a substantial outperformance of cumulative dividend income for Verizon versus the market. However, we still continue to see weakness in capital appreciation. So this investment is really all about dividend income, at least in my opinion. I think it's also important to point out that the payout ratio got very, very high for Verizon in 2011. You can see that again when you go down to the performance table. There were several years here where it was paying out 85 to 90% of their dividend income, and since earnings have improved, that payout ratio has actually fallen in recent years. Next, now regarding the future, I'm going to turn to the forecasting calculators. And I want you to notice that Verizon is rather well followed. There are 31 analysts forecasting very strong growth for 2018, over 21%. And then there are 28 analysts that expect a modest growth in 2019. And then it drops down to 13 analysts. But a couple of points here. Number one is the analyst scorecard has been very good for this company over the last 5 years. They've clearly met analyst forecasts within a 10% margin of error in each of these years. So these forecasts, at least based on historical record, may be decent. And this means that future performance for Verizon looks very, very attractive. Double-digit rates of return even after the flattening of earnings, which are expected in fiscal year 2020. But this company does offer great return, but primarily driven by valuation and its high current yield. My next research candidate is National Retail Properties. And here I have the whole graph. I have the dividends that they've been paid out. I have the dividend growth record. And then, of course, I have the funds from operations. With REITs, I'm utilizing the metric funds from operations rather than earnings. And what I find really interesting about this graph is you really see some great lessons in valuation. I want you to notice that this stock was very undervalued on a price to FFO basis in 2001. So if I go down and look at the performance over this time frame, you will see that, first of all, the dividends have grown at a reasonable rate of about 2.4% over the years. But because they've offered a high yield and valuation was so low, we see that dividend income stream based on a $10,000 investment on December 29th, 2000 has increased from $1,236 to $1,825. But I think the most telling part of this performance record is look how it has trounced the S&P 500 on a total dividend income basis, and I might add a capital appreciation basis. This has been a stellar performer over this time. However, I'd also like to talk again a little bit about the importance of valuation. I'm going to shorten the time frame here, drop it to the last 10 years, and I want you to notice that the price to FFO back in December of 2010 was 20.2. It currently is available at I'll call it a fairly valued price to FFO of 15. Now, this had a tremendous impact on performance relative to the S&P 500. You'll see that it underperformed the S&P 500 over this time frame on a capital appreciation basis, but once again we see a significant income advantage. Even though we would have purchased it at a high valuation back then, you still generated more dividend income than you would have received from the S&P 500. So going forward, this investment also looks attractive from the standpoint of analyst forecasts. The stock currently is fairly valued at around a 15 PE, a little high, but I'd call it fully valued, but not overvalued. And this would give you rates of return in the 7 to 8% range with a 4.9% current dividend yield. So this isn't the most attractively valued candidate I have now, but at least it is one that is reasonably valued at current levels. My third research candidate is the packaged foods and meats company, primarily known for their cereals, General Mills. And what I've done here is I've actually have my own personal history with this stock. I purchased it in December 14th of 2009 at a PE ratio of 15.9, and then I held it up through January of 2017, and I want you to notice that valuation became what I considered excessively high, and once the stock started falling, I made the decision to go ahead and sell the stock at that point. Now, that saved me over 27% potential capital loss, but what's important about this is I now find this stock intriguing again as a high-quality blue-chip dividend growth stock with a higher current yield. I'm going to shorten the time frame down here to 15 years where you have some reasonable valuation. And if you look at this company from a standpoint of performance since May of 2005, it almost doubled the dividend income that you would have received had you invested in the S&P 500, slightly underperformed it on a capital appreciation basis, and came out pretty close on a total return basis. But again, these particular research candidates are all about the income. However, I'd like to conclude this portion of the video on General Mills by simply restating, if you will, the importance of valuation. You can see that valuation got very high by July of 2016. And over that next couple of years, you would have had very poor performance on this stock. However, I do want you to notice that the dividend income increased each and every year during that time frame. Now, if I shorten the time frame to just the period that started in May of 2016 here, I want you to notice this company has a May fiscal year. I want you to notice that high valuation was the primary culprit here. The company's earnings growth was pretty much normal, 4 or 5%. That's historically what this company achieves. But I want you to notice the effects of high valuation. Over this time frame, a $10,000 investment in General Mills would have shrunk to $7,160 during a time when the market actually had moderately decent return performance here on a capital appreciation basis. The company still, even considering the high valuation that was paid, outperformed the S&P 500 on a dividend income, but it ruefully outperformed it. Valuation matters, and it matters a lot. My next research candidate is the biotechnology spinoff from Abbott Labs, AbbVie. And I want you to notice this stock was very attractively valued when they first went public in 2012. You could have bought it at around a 10 PE on December 31st, 2012. And I want you to notice that price tracked earnings, and you can see this period where it gets above the earnings line and it returns, and then it gets below the earnings line, it returns. And recently, coming into this year, we had a pretty high valuation, almost a 20 PE in February, but the stock has now retraced back to fair value. So I would consider this stock fairly valued at current levels. Its track record, even though the performance has been relatively weak for the first part of this year, it still dramatically outperformed the S&P 500 over its life. You can see that it beat it in a capital appreciation, but again, To stay consistent with the theme of this presentation, it almost more than doubled the dividend income from the S&P 500 and generated a great total return. Going forward, this company is forecast to grow at very high rates. The analyst scorecard is very attractive, so this could be not only a high income or above, almost more than double the yield of the S&P right now. This company also is positioned to be a very strong total return performer going forward. My next research candidate is Brinker International, primarily best known for their Chili's restaurants and their Maggioni's Italian restaurants. And I've left price off the graph here because I'm going to bring that in here in a moment. There's a couple of points I want you to see. Number one is this company started paying a dividend in 2006, and I want you to notice that that dividend has grown very nicely over all these years. They did have one flat year in 2016 going into fiscal year 2017, and they had 2 or 3 down years during the Great Recession. But even during those times, notice that their dividend income stream. But when you look at the price and earnings relationship here, I think you see a very profound relationship. You see this tracking of the orange line, if you will, but you also see these periods of disconnect where the price gets above and below it. And then, of course, during the Great Recession, we saw this significant undervaluation followed by some really stellar performance over the next several years. And then the down year in fiscal year 2017 created a very strong reaction in Brinker's, which did a couple of things. One, it gave it an attractive current dividend yield and a nice low valuation. And I want to put the dividend yield graph on here because this to me is a really great valuation reference. You can see that the dividend yield in this stock was highest when its valuation was lowest, and when its valuation got high is during periods of time where the dividend yield was at a lower level, as you can see by this graph. It's currently available at a 4% dividend yield, and if you look at the historical track record of this company, a $10,000 investment made on June 30th, 1998 would have generated, even though it didn't pay dividends all those years, I might add, more than twice the total income from the S&P 500, and it also beat it on a capital appreciation basis and a total return basis. And importantly, that's in spite of the fact that the company is currently so undervalued. So even low valuation didn't have an impact on this stock. If you measure it from fair valuation back in 1998 to peak valuation, and I'll get pretty close there, you can see the rate of return was almost 14% a year over that time frame. This is an interesting company. It does have a lot of debt. It's only BB+ rated, but it offers high current yield and the opportunity for some capital appreciation if you're willing to take the risk. With my next research candidate, I'm going to take a look at Pfizer Inc., the pharmaceutical giant, $209 billion market cap, AA rated, very modest debt. But I find this to be a very, very interesting story because if you look back from, let's say, going back here from 2004 back, and I'll go ahead and scroll back to that time frame, I want you to notice that this company was growing earnings at a very rapid rate. The company was very highly valued, a PE of almost 77 back in 1999, which of course caused significant underperformance, and then it became very undervalued. But more importantly, I want you to notice that those growth years have been over since 2004. I want you to notice that if I shorten this for a 16-year graph, which by the way includes a couple of years of estimates here, I want you to notice that the growth rate has fallen dramatically to only 2.5%. And during this period of time, we also came into the recession. You see where Pfizer did cut their dividend. They went from $1.28 to 80 cents down to 70 cents, and then they started raising it again in 2011. Nevertheless, the long-term performance of this stock has been decent on the dividend income in spite of the fact that they had these 2 dramatic dividend cuts in 08 and 09. But the real point is they underperformed the S&P on every aspect except dividend income. On the other hand, if I shorten this graph down to post-recessionary periods when valuation was very low, you could have bought Pfizer in December 31st, 2010 at a PE of 7.9. And I do want you to notice from a performance point of view from that period going forward, the company grew their dividend very nicely. They, again, approximately doubled the S&P 500 in total dividend income on a $10,000 investment. Capital appreciation was close, but they did underperform, and they only slightly underperformed the S&P 500 on a total return basis. But keep in mind, they did generate substantially more income over that time frame. With my next research candidate, I'm going to take a look at the Canadian bank giant Royal Bank of Canada, $140 billion market cap, AA minus rated. What's really interesting about this particular stock, now I've got the New York Stock Exchange version here, so all of this is in US dollars. And I want you to notice the dividend record here shows a few dividend cuts. However, I'm going to do something interesting for you here. I'm switching to the Canadian exchanges, and I'm going to redraw this graph utilizing the Toronto Stock Exchange version. And I want you to notice the dividend on Canadian dollars has been very strong. This company has dramatically outperformed the S&P 500. Now, this is a little wanky here because I'm using the Canadian version of Royal Bank, which has Canadian dollars, and I'm using the S&P, which is in US dollars, but you could still see the tremendous yield advantage. It generated significantly more dividend income than the S&P, and it outperformed it rather nicely on a capital appreciation basis, giving a total return advantage to Royal Bank of Canada shareholders over this time. I consider Royal Bank attractively valued right now based on a normal PE of around 12.7. However, it's not significantly undervalued. My next candidate is another Canadian company, Thompson Reuters Corporation, which recently spun off their data side, by the way, I might add. But this company is only interesting from a valuation point of view. You can see that their earnings history has been rather lumpy. You can see how horrible high valuation, what an effect it's had on performance of this company over this long period of time. However, the stock has recently come into fair value territory and looks reasonably attractive going forward on that basis. But this is one that is only in here because it offers an above average 3.5% dividend yield. It has relatively low debt to capital. It's BBB plus rated, but it is a Canadian company and it's moderately attractive on a valuation basis. My next research candidate is Target. And you can see, I think, a very interesting price and earnings relationship here. You see an excellent dividend record. If you look at Target's long-term dividend record, you've seen that they've increased their dividend by over 15%. However, the last couple years have been a little lower because of some earnings stress that I'll go back to in a moment. But you can see how the income stream, I call this growth yield, others call this yield on cost, has increased dramatically over time. The company dramatically outperformed the S&P on an income basis, and it's also outperformed it on a capital appreciation basis over this long-term period of time. On the other hand, in more recent years, going since 2012 to current, Target has not outperformed the S&P 500. They did moderately outperform it on a dividend income basis, but the real point is this would have been a good time to buy it, would have been last summer, June or July of 2017. As you can see, it got significantly overvalued, where you had this little drop in earnings, and of course we all know the story of where that came from and how investor sentiment changed on this stock. It's currently fairly valued, offers a 3.5% dividend yield. It's A-rated, has 48% debt to capital, and again, looks like a decent income investment going forward with some pretty good return potential as you look out for the next 2 or 3 years. Especially this year, the opportunity to generate a nice compounded annualized rate of return over the next year or so looks reasonably well defined. The company's analyst scorecard is not as good as some of the others that we've looked at. The company has missed earnings on 2 occasions over the last 5 years by relatively substantial amounts. Again, this 2014 number is well known and well defined as far as what happened with their bathrooms and some of the other issues. And finally, I offer Kellogg for your consideration. This is a company that was recently very highly valued back in July of 2016 with a PE of almost 23. And you can see that we've had this, what a lot of people like to call reversion to the mean. Another thing I want to point out here is that the growth of this company over the last couple of years and forecast going forward has averaged about 7%. Forecasts are for exactly that to continue over the next 2 or 3 years, which would make this a reasonably attractive dividend opportunity with a current yield of 3.3%. However, performance has not been stellar for this company over this time frame, once again attributed to the high valuation, but you can't buy what's popular and do well, as Warren Buffett said. Valuation is at least now reasonable for Kellogg. This has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this. I look forward to my next series, part 3, soon.